Good afternoon, everyone. Welcome to the Share Series Monday Management Update. I'm thrilled to be here today with the management team of Superior Group Companies. We have Mike Koempel, the CFO, Phil Kosa, Chief Strategy Officer. And I think to get started today, you're going to give us a little bit of an update on what the company is with the three diversified business platforms with a significant TAM.
Sure.
Hang on one moment here.
We'll maybe pull up a little bit of a presentation here just to have a couple slides to aid us along the way. Mike will be pulling that up. And it looks like, all right, we're up and running. We can see it. So I'll take a stab at the start of this, and then Mike can maybe round it off. The SGC was founded over 100 years ago, so a lot of history there. We spent the first probably 85 or 90 years of the business in the healthcare apparel world, and eventually in the uniform industry. But over the past 10 years, we've transformed ourselves. We've become an incredibly dynamic business operating across three diversified business segments: healthcare apparel, branded products, and contact centers. And this diversity, it's helped us in many ways, but it also makes us a bit of a hidden gem on Wall Street, because a lot of the institutional traders just look past diversified small cap and micro cap companies. They don't spend the time to really understand the story and realize the underlying value of each of the segments. But when they do, they're excited about it, as we are. And so I'll touch on each of these segments just briefly here, just to give you a flavor of what we do in each one. So we've got our healthcare apparel business. That's our legacy business, been around for 100+ years. And our healthcare apparel segment is one of the larger medical scrub providers in the country. The medical scrub industry is a $4 billion industry in which we have about 6% of the market share. We sell our scrubs through retailers and e-tailers and have a extremely loyal fan base that keeps coming back for our various brands that we carry. And while we don't really compete directly with FIGs, that might be a comp to look at if you're new to the story and you want to look at our segment a bit more and learn a bit more. The second segment is branded products. Our branded products segment makes promotional products and uniforms for really some of the largest companies in the world. Companies like Tesla, Walmart, Amazon, Microsoft, Taco Bell, JetBlue, Duncan, just to name a few. And we're one of the fastest growing and the top 10 of the branded product companies in the US. And this is an industry that has a $25 billion TAM, and we make up just over 1%. And then lastly, we have our contact center segment, and that's basically a nearshore provider servicing small and mid-sized businesses. TaskUs might be a comp to look at when thinking about this segment if you're new to this area. We're a bit different than them, but they certainly are in the same general industry. And in this business, we've been on an absolute tear. 30% plus 5-year CAGR at nearly a 24% EBITDA margin. So it's an incredible business, and this industry is a $100 billion TAM, so the sky is really the limit. So I'll kind of stop there and pass over to Mike, but really three very exciting businesses to be in that we're very happy to be in.
Sure. Sure. So from an investment standpoint, as Phil mentioned, we operate in three diversified segments of the business, each with large addressable markets, and we're just a small percentage of each of those addressable markets. We have a history of taking organic market share, and we believe that we continue to have an operating advantage in a highly fragmented market across each of those industries. Plus, we have opportunities to expand internationally. We've demonstrated a history of investing in technology. We recently made investments in our distribution centers last year, which we believe will help us to become more efficient and drive more value in the business. And we have a very experienced management team, a good combination of leaders who have been with the business for a number of years, as well as new leadership, and a mix of new thinking together with the history of the business. And most importantly, we've paid a consistent dividend. We've increased our dividend at different points in time, and we've paid a dividend consistently since 1977. when you look at the business over time, our business has grown significantly from 2012 to 2021. Our sales in 2020 and 2012 were just under $120 million. And in 2021, our sales for the full year were $537 million. So that's an annualized growth rate of 18%. And it's really been a good mix of organic growth. About 13% of that growth over that period of time was organic growth across the segments, and about 6% from acquisitions. So we've really had a nice balance of, again, both organic and acquisition related growth. Acquisitions really driven by acquisitions within our healthcare apparel segment, as well as in branded products. With that, Dana, I'll turn it back over to you.
Terrific. Thank you very much, Mike and Phil. So I'm Dana Telsey and just want to start the discussion. Let's talk about the then, and then we'll talk about the now. So when you speak about the then, what were the learnings for the company coming out of the pandemic? What did you experience? What did you learn from it? How did the business adapt coming post the pandemic?
I'd start with Dana. I think what we demonstrated during the pandemic was really an opportunity where we really pivoted the business. We generated well over $100 million in what we call PPE related sales. And so it was a difficult environment that we entered into, but we really demonstrated the ability to really pivot both our healthcare business as well as our promotional business to really drive some level of growth during a very difficult period of time. Now, as we've come out of the pandemic, I think a couple of things. One, we were able to take some of the incremental volume from our PPE related sales and really help drive core growth in our core categories. So taking again, the advantage of our additional sales during the pandemic and turning that into, I'd say, longer, more sustainable sales in our core categories. I think what we've also seen coming out of the pandemic is that certain investments that we made to manage the pandemic are obviously at this point not as critical. Our supply chain challenges are not as significant as they used to be. So we're looking at where can we create efficiencies and operate now more efficiently now that some of those costs are no longer necessary, and investing in new capabilities to continue to grow the business. So I think we certainly learned, as a lot of companies did, about managing challenges in the supply chain. Fortunately, we had no interruptions in our supply chain given our active management of that throughout the world. And it's really set us up well to continue the organic growth of the business coming out of the pandemic.
Great. And now if you think about the now, we're all hearing about challenges or cautiousness in the current demand environment, given the economic uncertainty. What does it mean for Superior, and what have you seen from each of your business segments?
I think I'll take that one. It's probably worth breaking it out into the three segments to address that. Starting first with the contact center business, demand increased pretty significantly during COVID, and I would say that has not slowed down. There's, as everyone knows, still challenges in the labor market in the U.S., and so more and more companies are looking to contact centers and looking to offshore opportunities. And I think we fit perfectly in the niche of offshore, but with high quality. We have amazing accent neutral agents. And so what you don't maybe get from the big call centers, especially some of the ones out in the Philippines and in India, in terms of quality, we're able to provide that. So demand has been, if anything, I would say pretty high in the contact center world. When you look at branded products, typically in a downturn, average order size might decrease a little bit. You might get a little bit of customer pullback on spend. Some spend more, but on average probably pulls back a little bit. However, this segment has done quite well in past recessions because it's a really great opportunity for us to take market share. And we take market share by winning over new customers and also by recruiting sales folks from our competitors. So, I think that we may see a little bit pullback in demand, but we don't expect that to affect us in a negative way in terms of our overall growth plans for the business. And then lastly, healthcare market, as I think everyone knows and has seen, the healthcare market's been a bit soft. We can't predict exactly when that will come back, but we are investing in our business for sure, because we know that this is a growth industry long term. So we're investing in new capabilities, we're investing in new talent. We brought in a new president of that segment, and really focused on the areas that we can control. And we know that when the industry does come back here, when that happens, that we will be more than ready to take advantage of that and pounce on that.
Got it. Now, when you look at the three different categories, what's the segment opportunity for each? How do you see the CAGR over the next 3 years or 5 years? How would you frame it?
So I think that this one, I'll probably just merge it together. In each segment, we definitely have some real unique competitive advantages that have allowed us to grow over the past decade. And we have some pretty unique opportunities within each segment as well. But when you pull back and look at the three segments overall, it's really exciting for two main reasons. Number one, the industries that we're in have grown significantly over the past 10 years, and we believe they will continue to grow very strongly over the next decade as well. And the second reason is that we are significant players in the industry that have tremendous strength in the industry, but we also are in low single-digit market share in all of these industries, and all these industries have very large TAM. So that when we think about the opportunity, of course, there's individual opportunities for each segment, but more broadly speaking, those are the two areas that we're so excited about, and why I think a lot of our investors get excited about our story.
Got it. One of the things that we're talking about every day lately is about inventory and supply chain. What is the supply chain opportunity for you? Are you seeing the tailwinds of whether it's lower ocean freight rates, lead times improving? And what does inventory look like now? And what do you expect it to be perhaps in the first half of 23?
I'll maybe the supply chain side, and then Mike, maybe you go into the inventory side of it. You're definitely right about supply chain. Costs of shipping have decreased very significantly over the past number of months. Everyone remembers during 2021, 2022, this rising cost of shipping that just seemed to never really have hit a ceiling. Well, it hit the ceiling and it fell pretty quick. So from a supply chain perspective, I would say we are business as usual, as much as supply chain can be business as usual. There's always the occasional disruption, and whenever you're running a global supply chain, things can happen geopolitically, things can happen, natural disasters, all the rest of the stuff can affect the supply chain. But overall, I would say we're in somewhat normal conditions now. And really, when you look at it from a standpoint of how the inflationary headwinds might be affecting our business, we've increased our pricing to our customers, and that's helped mitigate some of those inflationary headwinds. But we're also beginning to see some supply chain costs coming down, and we anticipate that we'll be able to benefit from that in the future as we purchase inventory for the future.
And from an inventory standpoint, Dana, one of the mitigate actions we took during the pandemic was to build a level of inventory to protect ourselves against any potential supply chain challenges. So as we've come out of the pandemic, like some other companies, we have some inflated inventory, particularly in our healthcare business. And so we're actively managing that down over time. Earlier this year, we began to pull back on purchasing of new inventory, and we'll begin to see the benefits of that as we get into 2023. And so again, major focus of ours, probably over the next, I'd say 6 to 12 months, we'll be bleeding inventory down to what would be more our historical levels. But most importantly, we're not missing sales, and we can service the needs of our customers and be able to do that going forward. And as Phil mentioned, we're not seeing supply chain challenges, so we feel good about our replenishment opportunities going forward as well.
Got it. So we unpacked a little bit of the healthcare apparel business. Tell me about the branded opportunity and the branded uniform side. What are the drivers there? What are you seeing in terms of new accounts, existing accounts, and trends that you're noticing?
One of the things, Dana, that we're excited about is that earlier this year, we restructured the business. Previously, we had a promotional products business and a branded uniform business that were really operated as separate businesses. And we saw a really important opportunity in integrating those two businesses together to form what Phil referred to earlier as our branded product segment. Historically, if you think about our branded uniform business, we had about 5 salespeople covering that entire business. Whereas in our promotional business, we had over 70 sales representatives. So by really combining and integrating that business into one branded product segment, we're now beginning to get the leverage of a much larger sales force across branded uniforms, which now, as we approach existing customers and potentially new customers, we can do so now looking at a broader portfolio of product that includes a number of different promotional items, but now branded uniforms. And so that provides us with some cross-selling opportunities, as well as opening some new doors to us in terms of new customers. So we're I would say still at the early stages, of that integration, but we're excited about the opportunity that's going to bring, especially as we get into potentially a more challenging economic environment. I think we'll really benefit from that integration and leverage across all categories in the branded space.
And with the economic environment and order sizes, what are you seeing in order sizes of that business? And the layoffs that we've heard from larger companies, is that at all an impact, or is it you gathering new customers, the new versus existing customer path?
I would say order size is ticked down just a bit. I think I'd mentioned that earlier on the branded product side. We sometimes tend to see that when there's some fears of potential recession and maybe marketing budgets get chopped a bit. But like I mentioned before, I hate to say we're excited for a recession, because no one's ever excited for a recession. But what I can say is, looking at our track record of growing during all past recessions, it definitely feels like there's opportunity that will be looming here for us to gain market share. And so we aren't going to go and count on customer spend going up, or we're not going to count either on order size going up. In fact, in our modeling, we anticipate those might go down a bit, might take down a bit. The one thing we do anticipate will go up is our market share, to more than make up for that. And that's been our strategy in the past. And we believe that will work going forward as well. So that's going to be our focus. When you look at our strategy over the next few years, it's all about gaining market share in the promotional products and in the promotional uniform business. And we believe we've got the sales team to do it. We believe we've got the strategy to do it. We certainly have the capabilities to do it. And if you look at our customer list, we're trusted by some of the largest businesses in the world. And they trust us, and they've been with us in some cases for decades for a reason, and that's because we are able to deliver. So we're ready for whatever choppy waters are ahead.
And it seems like another opportunity for growth could come from overseas in terms of international. What are you seeing there for the business? Is that an opportunity, and how does the pricing and margins compare?
We do see an opportunity, Dana, in international. I would say we're at the very early stages of evaluating that opportunity. I think as Phil mentioned, we have a new leader in our healthcare apparel segment who joined us just a few months ago. So I'm sure once as she continues to work through the strategy with healthcare apparel, that will include international. We've started we have some business today internationally in Canada and Europe, but it's fairly small. We believe that there is opportunity internationally, and we're again continuing to evaluate that plan and determine exactly the time frame and the size of that over time. But there's no question that'll be a big opportunity for us in the healthcare apparel space.
And then in this environment of inflation, how are you handling inflation? What prices increases did you take? Are you still taking any? How are you dealing with that?
We're dealing with it in a couple ways that actually you just touched on. So we have increased prices across all three of our businesses. in some cases, some of our business is contractual and we're able to take those in connection with the contracts that we have. Others are negotiated on an as order basis. And we've had a lot of success across all three of our businesses of taking price increases, which to a large extent has mitigated, a lot of the cost pressure, but still feeling the cost pressure nonetheless. We'll continue to evaluate, Dana, across each segment, our ability to adjust prices as we move forward. So that'll always be a constant that we'll continue to evaluate. Apart from the pricing, we're obviously also looking at our cost structure. As I mentioned before, there were certain costs that we were incurring as a business that were necessary during certain times, such as the pandemic, that aren't as relevant anymore. So we have identified, as we disclosed in our second and third quarter earnings, we've identified annualized cost savings of at least $8 million that will begin in 2023. But we're continuing to look for operating efficiencies. Where can we, again, get more efficient and reduce our cost structure, but also, again, look for opportunities where we can increase pricing. And we believe the combination of those two actions will enable us to navigate the current environment.
And then when you think about capital allocation, what is the capital allocation strategy? How will it change going forward? How much do you typically spend on CapEx, and how's that adjusting?
Sure. So we typically, in capital expenditures, we're in the 1.5% to 2% range. What I would say, quote, in a normal year. We did spend more than that in 2021 as we were putting more automation into our warehouse. So we will invest more, obviously, where we see the appropriate return on investment, but on a normal basis, again, in that 1.5% to 2% range. That would be our expectation going forward. In terms of capital allocation, I would say, first of all, one of the things obviously that we're focused on is driving working capital improvement. I mentioned the inventory, that we're very focused on driving inventories down, which will improve working capital. And therefore, from a capital allocation standpoint, we look to reduce some of our outstanding borrowings. Obviously, interest rates have continued to increase, and so has ours, and so has our interest expense. So we'd certainly look to, as we generate additional cash flows, we'd look to reduce our debt levels over time. And then continue to stay focused on getting returns back to our shareholders and continuing our dividends as we move into next year. So I'd say, looking forward, it's scrutinizing capital expenditures in a challenging environment, again, in that about 1.5% to 2% range, reducing our debt and continuing to return value back to our shareholders.
And of your three different business segments, which do you see as the fastest growing and has the most opportunity in the near term and midterm?
You can't ask us to choose which child is our favorite. That's a tough one.
Well, they're all your favorite.
Yeah, I mean, I think I know my answer is going to sound super hedged, but the truth is that we are in these three segments because of the fact that we think all three of them have incredible opportunity. If you just look back, historical CAGR and EBITDA margin, I would say contact centers probably looks the healthiest. Like I mentioned earlier, nearly 24% EBITDA margin. And that continues to improve, or has improved over the years. So, that one probably is one that stands out, I think, most to investors as wow, has a real wow factor. That said, the healthcare industry is going to continue to grow tremendously. And so for us, there's a lot of opportunity there. We have a new omni-channel strategy and a ton of new leadership on board that we cannot wait to see, how far we can take things. And then branded products and uniforms, when you look at our position in the industry, we're in the top 10 in the industry, but then you look at our actual market share, only 1%. It gets very, very exciting. And so, I would say right now we're hesitant to bet on any one, Otherwise, we would just sell off two and just bet on that one. We are really excited about all three, and we think all three have huge upside potential.
And the portfolio approach, there's scale with that, I assume.
Exactly.
Sure.
There's leverage, there's scale, and as we've said publicly many times, we intend to work on our EBITDA margin and continue to find ways to improve our EBITDA margin, and a lot of that comes through this scale.
Now, if you had to tell the investors here on the Zoom or in the conference, what are the 3 or 4 key reasons to invest in Superior? If they were going to come away and say, here's why I'm interested, what would each of your key takeaways be?
I would say growth industries with large TAMs in which we are a significant player, but we don't have any kind of significant market share. That would be the one takeaway I would say about all three businesses that are true across all three businesses. And then I also think that investors should probably, I would say, take one other thing away, which is that can be somewhat complicated. Like I mentioned at the top of the hour here, was when you have a business, the small cap or micro cap, and we're in 3 different business segments. A lot of investors don't necessarily put the work in to understand the underlying value, which is understandable. But the good news is for those that put that work in, they can really see the incredible diamond in the rough there, and we're very excited about our business as a result.
And I would just add, as I mentioned early on, we have a demonstrated history of growth across all 3 of our businesses. So we're not just saying it, we've actually done it. And I think that when you look back in some of the most challenging economic times, again, more recently in the pandemic, I think our company has shown resiliency and agility in terms of managing the business and really with strong performance both during and after this. And so I feel like, as Phil said, we have a lot of growth opportunity in each one of our businesses. We're excited about the leadership team, that's in place. And as we have in our investor presentation, which everyone can read on our website, we have a goal of getting to $1 billion in sales, and we definitely see the pathway to get there over time.
One of the most impressive things to me about Superior is that I believe that the past informs the future. And given your 100-year-old plus history and legacy that's out there, it helps you build upon that. I had a grandmother who lived till 103. I was very fortunate, and she kept working all the way into her 90s. So the opportunity for growth continues to exist. Let's fast forward. Instead of being November 14th, 2022, we're here November 14th, 2027, all still at the same age, not 5 years older. Where do you see the company being? What will we say? Yep, here's what is the biggest positive surprise as we're sitting here in 2027, not 5 years older, by the way.
We have one very simple goal. It's an objective that our entire management team is laser focused on. We are obsessive about it, and that is to grow to be $1 billion company. And when we do that, we're going to achieve the leverage goals that we were talking about. We'll be able to improve margin as we go along the way, and really increase overall service level to our customers, growth opportunities to our employees. But that's what we've been focused on, and that's what we will continue to be focused on until we get there. Whether or not it'll be exactly on November 14th of 2027 or a bit earlier, a bit later, we'll see. But I would say that all of us would be probably very disappointed if it didn't come to that point at an earlier date. And yeah, that's our big focus.
Very exciting. Anything you'd want to leave our participants with today before we close out this session?
I really appreciate it, Dana. Thanks so much for all the questions, and we appreciate all the investors who called in for this and listened in for this. We have a deep respect for the retail market. We believe that some of the most savvy investors are actually in the retail market. We've seen that online with some of the best coverage that we've gotten is through online forums and people who do write-ups on our business, and you go, wow, they really get it. And so we're really appreciative for the opportunity to be on here today, appreciative of everyone's time. And Dana, thanks again for hosting this and asking the questions and all. Really, really appreciate it.
Well, I want to thank you, Mike and Phil. You're certainly exciting opportunities ahead. I love the legacy that informs the future, but also how you've enhanced and reinvigorated the present. So I want to thank you for taking this opportunity today to share the Superior story with the investors. Thank you. Thank you, Mike.
You,
Thank
Dana.
you, Phil. I want to
Thanks,
thank
Dana.
everyone on the platform for listening today. We look forward to all of you joining us at the next event on December 5th. Have a wonderful day, and thank you very much.
Thank you.
Thank you.